advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm, and our show is a financial show. We call it Something More because we like to talk about not only those important dollar and cents issues, but also those quality of life issues that make the money matters matter. With me today is Jeff Perry. Jeff, thanks for being here.
Happy to be here, Chris.
Jeff,
welcome back to the show.
Thanks. Thanks for stepping in for me while I was away. I was going to mention that as well. Thank you. Jeff, for our listeners, thank you for stepping in. Jeff is trained as a lawyer, has been had various experiences in the public sector, as well as now for the last couple of years been an advisor with Asset Management Resources and a student of financial planning and personal finance for many years. So, and I understand you're headed to a conference sometime soon. What's the conference you're going to?
In April, we're going down or up. See, I'm in Florida. There's another factoid. So I'm used to saying going down. I'm going up to Nashville, Tennessee to go to the Ramsey conference, which they hold, which is the first one they're going to hold at a new campus that they built. Dave Ramsey is a longtime radio personality, and
I'm sure people listen to talk radio should know Ramsey. But so that's good. Have you been to one of his things before?
We have. We went to one in Boston a number of years ago, and it was great. But we love Nashville by itself, so this is a good excuse to go up there and see Nashville. We're going to go to the Grand Ole Opry, of course, while we're there, and just have some fun and go to a conference and see if we can learn something. You always learn something when you go to a conference. You think you've read it all and seen it all from a particular subject matter, but just going and being there and listening to the interactions of the speakers and the classes, you always come back with something that you can use or reinforces something. I'm sure that you see that in the places that you go as well.
It's so true. Well, as we'll talk about maybe later in the show if there's time, I just went to a conference in Las Vegas for an Ed Slott program. It was a 2-day program, which sounds like, if you think about it, I'm going to go sit in a classroom for 8 hours at a time to learn about tax stuff. Sounds pretty bad, you know what I mean? But honestly, it was really interesting. It was chock full of great stuff. I've already had some occasions with clients that we've used some of the information gleaned from the occasion. So lots to learn. I'm sure we'll talk about some of the topics.
Sure.
They're just good to review from time to time with our listeners.
And there's been a lot of changes in tax law and investing, and I think our listeners probably see some of it on the news that scrolls by their televisions and radio. But the news that people take in passing that's interesting is really important to the business of financial services and financial advice and managing money. So we tend to be more focused on it than most people, which is good for our clients, of course.
Yeah.
But there's a lot of things that have changed in the last few years, and there's things that may be changing again in a couple more years. So,
well, that was my catalyst for wanting to go to this. Recently had the Secure Act 2.0 as a relevant change in tax law. And
absolutely.
It doesn't affect all areas of tax law, but there are a number of things that it did create some changes. And so that was my immediate prompt, but I'd heard some good things about this from some of our peers, some other advisors who said that it was well worth the time and investment. So took the opportunity to do that. As it turns out, we had been planning to address some of these changes with our clientele, and we invited the public, our listeners on the radio show, to join us for this webinar we just did this week was it Wednesday?
It was on Wednesday. Yep.
Yeah. So for our listeners who don't know, for our clientele, each quarter we do really we do two quarterly webinars.
Right.
One is more geared toward markets and the economy and sort of outlook as it relates to how that might affect people's portfolio design and some of the things we're doing here for our clients. And we share that with our clients, how it's working into our discretionary portfolio management. And then the other quarterly webinar we do is more of a financial planning oriented. So it's other topics, things that affect your personal finance. And so in this case, a notable change in tax law, we wanted to go through what were some of the takeaways from the Secure Act 2.0. And so that was about an hour that we went through that. And it's really good because each of our advisors had the opportunity to contribute some of the content. You went in depth on 529 plans. Jeff Perry was in depth on, issues relating to, Roth IRA, Roth 401k. Some of these, there are some pretty significant.
There's a lot of
updates.
changes. It is a bit thick, I must say, the webinar. So
yeah, I
even
thought so too.
Yeah.
There was a lot to it when it came to, but I think, I don't know, it's hard to try to find that balance of have enough substance without being burdensome. But I think we tried to walk that line, mindful of that concern.
Well, the great thing about the webinars is you can go back, especially for clients who have access. But for this webinar, I think it was or will be posted on our YouTube channel as well, right?
Yeah, it's posted on our YouTube channel and it's accessible through our client section, I believe, of the website. But we have a section of the website that has past webinars on there, so it's attainable for anyone who would like to go check it out. We did go into some detail, but we'll talk a little bit about some of those kind of things that we touched on. We'll have a chance to talk a little bit about them today. Perhaps we can do that for a few minutes now if we'd like to. But in any case, before we do, again, thank you for stepping in for me. I had planned to, but didn't get a chance to listen to the show that was the podcast, last week.
Mm-hmm.
So hopefully we won't be redundant on anything that you talked about, but hopefully it went well.
Well, we'll see. But the last 2 weeks were fun. I like sitting in for you.
Thank you.
It's more fun with you, obviously, but it's
well,
fun.
I did get to listen to the Seinfeld.
That's where I was going. Yeah.
Oh,
we had been waiting, not we collectively, everyone at AMR have been waiting to find time to do this Seinfeld episode. And if this is something you're hearing for the first time, we were at a client event last summer, I guess, for clients of Asset Management Resources. And after the event, the team went out for a quick bite to eat, a drink. And I don't know how we get on the subject, but somehow we were talking about all the financial.
I think it was something with either Jeff Tamaning or Teresa, who
might have been Teresa,
both of whom are kind of big Seinfeld fans. And one of them said something about the idea of all these great financial lessons that could come out of Seinfeld.
Absolutely. And so we were all chiming in and entertaining ourselves anyway.
Yeah, I mean, that was a lively conversation. It just, it was like rapid fire. You could talk about this,
Well,
everyone's different fun episodes.
It was a great day because we had a wonderful client event. We got to see a lot of our clients all together and socialize with them. And it was a beautiful Cape Cod day. And then we went out afterwards. So everyone was, in a nice, happy mood. And it was just a good day. Yeah. And it inspired, let's do this on the radio. Let's talk about there's too many, but let's take an hour and share our favorite lesson from the Seinfeld show. So we did that, I guess it would be 2 weeks ago now.
Yeah.
And the feedback that I got from people that I know that listen to the show or listen to the podcast was very, very positive. Of course it was. That was great, but you didn't talk about,
they had their own ideas of things you should have.
It was like they wanted to be on the show. So
yeah.
If you're looking for some entertainment and a little finances on the side, go back and check it out on our podcasts. And it's, I think you'll like it. And, we could last week we touched on, I reminded people about the show with the Seinfeld episode, but we touched on other popular TV shows like The Office and Cheers, and there was another one, Parks and Recreation, and there was a couple more that we just touched on that, we could do one based on The Office, right?
Yeah.
Or any of these most popular shows. So
yeah, it's a good point. There's probably some funny anecdotes and lessons to be learned from these other
but
possibilities.
Seinfeld is the most iconic. It's yeah.
Well, anyway, it was kind of fun.
It
I
was.
enjoyed listening to that. One other thing that struck me, Jeff, I can't believe it, is next week we have the daylight savings time.
Right, a week from today, right? Week. Yeah,
isn't that incredible?
It is. I'm happy about it. I like
I'm
more
thrilled.
light. Well, so we're 1,500 miles away. So currently, it's getting dark.
Have longer days. Huh?
It's getting dark about 7:15 here.
That's great.
So we'll be 8:15, which is even better, right?
Wow.
So
yeah. So we won't have that until June. Probably.
Right. Anyway. Yeah, it just makes the day longer, and I like it, and I would be happy if Congress has talked about it every session, and almost everyone agrees, but they never do it.
Yeah, so it hasn't passed. I know there was talk about terminating.
I think it may have passed the House, but the Senate didn't take it up, or
was it essentially that they were going to make daylight savings time permanent? Was
correct? Correct. Yeah. No more falling back, spring forwards, but they didn't do it. There's a couple of states who don't do it, I think, but either way, it's
well, I hope that does someday come about.
Me too.
But in the meantime, I'm looking forward to it's already that time of year. It's hard to believe that seems like that's earlier than in the past.
I think it is.
While the Oscars seems later than in the past. I don't know. Could be me.
Yeah, well, it could be. I don't know. I lose track of all this stuff.
I don't know if there's any financial lessons to be learned from talking about movie stories or whatever. But anyway, we'll give that consideration. Anyway, if you got some show ideas, by the way, we did do a survey recently, and
it's still welcome
your participation and ideas, things that you do like, things that you don't like. We love hearing back from our listeners. So it would be helpful to us to know what do you like hearing about? What do you not like hearing about? And what should we do more on?
We're getting some good feedback. I mean, people are going to the website, amrfinancial.com. There's a radio tab on the top. You click that, and it's right on the top right-hand side of the radio page. But people are giving us good feedback. It's not all positive. They're saying, well, I'd like to see more of this and more of that. But it is important that we get this feedback. So just take a minute and do it. I mean, we appreciate it very much. We had we had a review of the results just so far, and I was very pleased with the types of feedback, the suggestions.
It's interesting to hear what people do and don't like, and so it will work its way into our programming. So we
absolutely.
Yep. Let's take a quick break. When we come back, let's go into a little bit, just a little teaser of some of the details from that program we did, and particularly we can talk about your efforts to educate people on the 529 plan changes right after this. Stay with us. Welcome back to Something More with Chris Boyd, and I'm Chris Boyd, certified financial planner practitioner. Our firm is Asset Management Resources. I'm joined today by Jeff Perry as my co-host. Thanks for doing so much on the radio show these days, Jeff.
So you're very welcome.
Here,
I've been told I have a face for radio.
Yeah, nice. Yeah. I doubt that. So in any case, we are going to actually, maybe we can do a little teaser for what we got coming up in the next hour.
Oh yeah. So that Something More.
Yeah.
Topic. You talked about this a few months ago, but the Something More topic is meant to at least hint that once in a while, we're going to talk about things other than personal finance. So from time to time, we have a special guest, or we have a topic like the Seinfeld, which was, half related to finance. But so we were brainstorming.
Just on the Something More.
Yeah, please.
So not only are we trying to help you, earn something more, that kind of thing, but we really have in mind something more. Life is about more than just money. And so we want our program to reflect that we're talking about, things that are important and can add quality of life, that fulfillment kind of thing, and some lessons of people who have either changed directions. Well, I love stories where
Mm,
people have reached great success. I find that inspiring. I also find stories where someone says, I had been on this track. I was on the treadmill, the rat race, and I switched gears for something I really have passion for, like
right.
a fulfillment story. So we try to include a variety of directions as it relates to this. So,
And,
and you
and
had a
back
thought on
and
this.
back to the survey, people like it. They like the personal stories.
Yeah.
They like that. So we had a little brainstorming session about who would be fun to have on the show, and I went back to a gentleman that I met. Oh, I don't know. It's a few years ago now. When I lived on the Cape, I was participating in the um, Christians business group. It has a better name than that, but I can't remember what it is.
Yeah.
But it was a monthly breakfast of different people. Everyone was welcome.
People
You
of
know,
faith. Yeah.
people of faith who also had business interest or community interest. And there I met a gentleman named Tracy Ferry, and I knew him. I got to know him there. He was a uh, associate pastor of the church that it was being held in, Covenant Church in Sandwich. And as I heard him talk, I found out that he is a musician, and he was the bass guitarist for Boston, the group Boston, which is very popular in the 80s, as well as Stryker and White Cross. And so
Fun.
here he is, this rock and roll star, and he still looks like a rock and roll star, by the way. If you Google Tracy Ferry Boston, you'll see his picture, and he still looks like that. But he's made this transition, talking about what you were kind of hinting at. He's made this transition from rock and roll star to pastor. And I just thought that would be an awesome thing to hear about his musical career. And I'm sure he's got a couple of stories about that, but also transitioning into being not only a person of faith, which I suspect, but I don't know, he may have been his whole life, but a leader in the faith community now. So
I'm looking forward to hearing more about
yeah,
that. It's going to be a good.
yeah. So he'll be on in hour 2.
So stay tuned for that. And we do have Brian Regan, our firm's chief investment officer, joining us for a little bit of a perspective. We keep hearing people worry about recession, and he's going to talk a little bit about, how should we think about
That's the number one thing clients and people who know what I do are asking.
Yeah.
You think we're going in a recession? What does it mean? Right. I mean, that's
right.
the only thing they care about right now.
So we'll talk about that shortly. Before we do, let's just chime in on, as we mentioned, we had this recent webinar where we talked about the Secure Act 2.0, and there were various elements that we focused on, whether it was, changes as it relates to required minimum distributions, catch-up provisions if you're contributing to your account. As we said earlier, there's all kinds of Roth changes when it comes to
Generally good news, though. Generally good news for
Yeah, I think
investors and
so.
savers, right?
Yeah, and similarly, there's some aspects as relates to qualified charitable distributions that have significant. But the 529 plan features was one that you spent time talking about, and have even drafted an article on the topic. Maybe we can just tell our listeners a little bit about some of these changes, and what are some of the
Sure.
important takeaways from this?
So we have this habit of throwing around numbers and sections of the IRS code and all that.
Yeah.
So let me start with the 529. It's a plan that allows individuals, usually parents and grandparents, to put money aside, after-tax money aside, for future educational expenses, usually of their children or grandchildren. And it's been around a long time. It's an
Well, that's
excellent.
not mandatory. It doesn't have to be family or anything like
Right. As usually,
Yeah.
it doesn't have to be though, right?
Right.
It's been around a long time. It's been very successful. We have many clients who have 529 accounts, and it's a great way to save. The primary advantage is when you put the funds into the 529 account, they grow tax-free. And at the time when the expenses are coming in for college, vocational school, also good for K through 12 private school, you
Yep.
can take the money out and make the payments for tuition and related approved educational expenses tax-free, which is a good deal, especially if you start saving for your beneficiary early, so you get all those years of compounding tax-free interest. There was ways that you could get your money out if you could pay the taxes and get the money out if the child didn't use the funds, or you could transfer it to a different beneficiary. So there were ways, but it was always kind of a question that people had.
What
What
if
if,
my kid doesn't?
yeah,
What if they're not college bound? Yeah, and then
what
the
if they get
idea
a
of having,
scholarship, right?
yeah,
Right.
right. I was just talking with we talking about this topic at dinner last night with a relative who did ROTC.
Yeah.
So he's like,
There you
"Oh, I
go.
wonder if," I say, he goes, "I wonder if my dad has money that he saved for me." You know, and so
Well,
I
maybe,
said,
right?
"Well, knowing your dad has like 5 other kids, he
Maybe
probably
not.
moved it down the family tree to the next one, you know."
Right.
But which you can do. But to your point, the worry people have is that if they don't use the funds as intended, you know, then they might have to take it out and have a penalty tax,
Right.
an income tax. One of the beautiful things about a 529 plan is the money goes in with after tax dollars. You've saved the money and you put it into this investment account. It grows free from taxes, tax deferred, if you will.
Yeah.
But if it is used for these college expenses, it has no tax.
Yep.
When
Doesn't
it's
doesn't
taken
get much
out.
better than that, really.
So it's essentially tax-free investing when applied to college expenses. When it's not, you then have this issue of an income tax on the deferred portion and penalty tax if it's not
Right.
used for this purpose. So,
Right.
so that's
So,
one of the worries.
and so
There's a way
people,
around it.
so people either said, I'm going to do something else. I don't want to deal with that. Or they would be hesitant to like aggressively fund it. They didn't want to put too much in because of what ifs, right? So Secure 2.0 passed in December of last year and signed as part of a larger consolidated bill in January, and has a lot of provisions. The one we're talking about, it that has to do with 529s, is now if there's extra money, for example, either for whatever reason, they didn't spend it all, they didn't go to college, whatever it is, the law will allow you to transfer up to $35,000. And there's a lot of rules. There's, 4 or 5 major rules that we can go over if you want, Chris, but just know
Yeah.
there's some rules, right?
Big time is you got to have the individual who's receiving this money has to have income enough,
Right.
essentially $35,000 as an example, if you do it on
Right.
a year, to do this technique.
Right. It allows the transfer from the 529 to the beneficiary, so the same child, the adult child now in this case,
Yeah.
to roll that money over up to 35,000, as you said, into a Roth IRA for the benefit of the child. Tax-free exchange. And now that the money's in a Roth IRA, when the beneficiary ultimately uses it, hopefully when they retire, that will be tax-free as well. So this money just stays in this cycle of growing tax-free and withdrawing
And of course,
tax-free.
what's beautiful about the Roth is when it comes out, it's free from tax entirely.
That's right.
So that you've gone from, this tax-free for educational expenses, but potentially tax-free retirement income if it wasn't all used. So it really is a nice feature. There are some caveats. Why don't you hit on some of those highlights?
Yep.
You have to have the money in there a while before
Yep.
you can think about doing this.
So it has to be the same beneficiary. So that's kind of obvious. The maximum is 35,000, as we said. The account has to have been open for 15 years. So if you
529 plan,
the 529, yep, before. So if you start young, when the child's born or young, you're good. But if you're starting later, you might have to wait a while if you're going to take advantage of this. And
right.
you can only transfer or roll over, I guess is a better term, the funds that are more than 5 years old in the 529. So the typical scenario, it works very well for the typical scenario where a child is born, someone sets up a 529, they're saving every month or a lump sum in the beginning. Child goes to college, has extra money. So in that scenario, the account's been open for more than 15 years. Most of the money was already put in 5 years prior to the rollover, because remember, the child has probably gone to school for 4 years, perhaps. So it works very well in the normal scenario. But if it's a certain circumstance where they're making a donation, a contribution to the 529 when the when the beneficiary is a teenager, it doesn't work so well because of the time limits. And as you noted, the beneficiary in the normal scenario, the child who's graduated from college has to have earned income to at least equal to the amount of the rollover. So they have to, it's like the child has graduated college and they're working, and then the money can be rolled over. So it takes away that initial question of someone who just had a child or a grandchild or a loved one, somebody they want to save for, and they're 2 years old, and you're saying, I don't know if I want to put all this money there, because what if
Well, they use it?
what if the child joins the military, gets a scholarship, doesn't go to college? And so this just takes away those objections and makes it more attractive to make that initial investment. And speaking of initial investment, one more exciting thing I think about these is, so you're allowed to gift up to $17,000 in 2023 to any individual without a gift tax consequence.
Correct.
The provisions of this law allows you to superfund a 529 and give 5 times the annual, so 17,000 times 5 or 85,000 in 1 year.
So you get essentially 5 years of gifting at a
Right.
single moment. Okay.
So if you're a wealthy individual or have those types of assets, you can, and you have a child, grandchild, or someone you care about, you can superfund this in the beginning and almost, excuse me, be done with it. You know, child's born, you put 85,000 in, it grows for 18 years, invested, compounded, and you're done. And if there's anything left over, it's another gift by rolling over the excess funds into a Roth IRA. That's quite a legacy for those individuals who are capable of doing something like
kind
that.
of capacity. Yeah. What a great idea if you have those kind of resources. A challenge for people who might have 10 grandchildren or something, but
It is, and there's different ideas with them. You don't have to do it all at once as well, and you can change beneficiary. So if I think the lesson for all of this is, listen to the webinar first. Go back and listen to the webinar if you missed it, but give us a call if you're a client or your prospect, meaning someone who might be interested in us helping you. Give us a call and we can look at your situation and see if there's opportunities created by Secure 2.0 that weren't there, whether it be in educational funding, IRAs, whatever it is. There may be opportunities that have just become available to you that you should at least consider taking advantage of. And I know we don't have time, but included in that list, and maybe we should talk about it some other time, because it's another great opportunity, especially with the tax rates, is the issue of Roth conversions. I think that's another big opportunity for people that is timely in the next couple of years. Because
there's some real good reasons for that, not the least of which is current tax law is scheduled for taxes to go up.
Right.
But not for a couple more years, So you got at the end of 2025, 2026, we revert to the tax code that was prior to the Tax Cut and Jobs Act, right? So tax rates go higher, bands for income levels goes lower. So you're going to be going into higher tax brackets faster. And so now's an opportunity to choose when you want to pay taxes. If you may want to fill in your tax rate, if you're in the 22% tax bracket.
It's a bit tactical, but
what you're going to be dealing with, but that's less than what it will be not too far into the future. And
markets are not near their highs. So
it's good.
That's a factor too.
Right. So
if you've been thinking about it, you should really reach out to us or whoever your financial advisor is and go through a process and see if it's the right time for you to at least consider it.
Yeah. When we do our financial planning with clients, this is one of the things we can examine, is to see, is there some virtue in thinking about doing some Roth conversions? One of the things you worry about if you have a big IRA is that your taxes are going to go up simply because your distribution requirements will get larger as you get older. And that can push you into higher tax brackets So there
And
can
that,
be some virtue to thinking about choosing to pay some taxes sooner with the Roth conversion.
and
Anyway,
that's magnified with the the new dates for when you have to take your RMDs. That could be even magnified more.
right. Exactly. So if you need to get some help on that, certainly reach out to AMR. We're happy to meet with you. We have a complimentary consultation, see if we can be a help. You can reach out to us through our website, amrfinancial.com. That's AMR for Asset Management Resources, amrfinancial.com. Or give us a call, 866-771-8901. We're going to come back right after this with another segment. But we're going to be talking with Brian Regan, our firm's chief investment officer, with the question people are asking, will there be a recession? All right, let's talk about that right after this. Stay with us. Thanks for being with us for another segment of Something More with Chris Boyd. I'm joined now with Jeff Perry as well. We have Brian Regan joining us. Thanks for being here, Brian.
Hi, guys. How you doing?
Good. So Brian is our firm's chief investment officer and always thinking about the future and what's coming down the pike with our portfolios and how we want to be positioned to deal with what may come. So, Brian, Jeff and I were saying this is a question that we get a lot these days is, are we going to have a recession? And, how does that mean I should do something different for my investments? So that's not necessarily what you had said on your title of what we want to talk about here, but I think that's the inevitable.
That's a two-step that's going on right now.
Yeah. So tell us, what's your take? What's happening?
Well, I guess I won't bury the lead. I just don't think there's enough evidence to tell one way or the other. And that might be unsatisfying to people, but I would love to know what people are looking at when they say definitively that there is going to be a recession or there isn't going to be a recession. I think,
don't you think the reason people think that is because we suddenly just raised rates by almost 5% soon? And that you kind of expect that it has to have some economic slowdown consequence, right? That's got to be just the shorthand thought process, right?
Yeah, but we were so hot that if you come down from extreme hotness, you don't necessarily need to freeze, right? You can be temperate. And I think that's kind of the debate, right? And I think you're right. I think that's the reason why people assume it's going to happen. I think historically, this type of rate rising would lead to a recession. But if you just look at the data, and I'm happy to go through some of it.
Yeah, let's do that.
I just don't think there's a ton of evidence for one right now. So, there will be a recession at some point, but I just don't think it's first of all, I don't think
inevitable immediately.
It's not on the doorstep.
Yeah. So how much of the evidence that you're looking at is backward looking though?
Almost all of it, right? That's what we have to deal with.
That's the challenge.
Yeah. I mean, you can look at some leading indicators like housing starts, for example. But even that's murky, right? Housing starts have come down, but they're still fairly elevated compared to the last decade, a decade in the 2010s that saw a good amount of growth. We did have the 2 consecutive quarters of negative growth, but that was very short-lived. The last 2 quarters have been very positive for GDP. It's really hard to have a recession when the labor market's so tight. The unemployment rate's 3.4% right now. There's 11 million open jobs. We had a very surprise 500,000 new jobs in the non-farm payroll report for January. So none of that is recessionary, to say the least. There have been a lot of headlines about layoffs, but it's not showing up in the initial employment claims. It's not showing up in the continuing claims. They're at rock bottom levels. So, these people that are getting laid off are either finding new jobs, or there's just not enough to make a dent.
Well, there was some explanation of that. I'd heard that related to the announcements came maybe 2 months before the actual layoffs came. Then some of these layoffs, they probably have severance pay, and so they're not quite jumping on the unemployment line right out of the gate. So you got to figure that's a few months of potential before it hits the data, wouldn't you think?
I don't know. It's tough to determine. I mean,
Yeah.
if I got laid off, I'd go to the unemployment office the next day. Whether I was getting severance or not. Like, why wouldn't you want double paychecks? So I
Are you
don't know. Maybe
entitled
there's
to
something.
that? Can you do that? I thought you had to wait.
Well, I've
Okay.
been lucky enough to never have gotten laid off,
Yeah, I
but
don't know.
Me either, but I think
I
you
don't
have
think
to.
that's the case.
I don't think you can be receiving income from your employer. But to your point, I mean, at some point it's got to start to show up. Even this past week, I was looking at the number and it was 190,000, I think, for initial, which was below expectations again. So it's not even like starting to trickle and not even starting to, gradually go up. It's still below what expectations. And to your point, Brian, there's no indication that the job market, despite the Treasury's, the Fed's efforts to slow this economy down, the job market is just holding strong.
Yeah, I mean, if you take into the fact that there's long and variable lags to interest rate hikes, right? We're probably only just feeling the effects of the beginning of the hikes now, in theory, right? But
Right.
you should see that in the more interest rate sensitive parts of the market, like housing, like autos, and the biggest home builders. They're not laying off people; they're adding people. The car makers, Ford laid off some people, but GM added people. So that's a mixed bag as well. I looked at some of the bigger employers to see if there was overhiring. There's certainly overhiring in Silicon Valley. Salesforce has made no bones about the fact that they overhired. Google, they hired something like 25% more of their workforce just in 1 year. So there's certainly evidence of overhiring in Silicon Valley. But they're relatively small employers compared to Walmart, Amazon, Yum Brands, Kroger, Home Depot. Those are your big boys for publicly traded companies that hire people. And there is some evidence that Walmart and Amazon have overhired. I think Amazon has said as much, and they've both had layoffs. But considering that millions of people,
Right.
work at these two businesses, and they're talking about a few thousand layoffs, it's not going to put a dent in it, right? So either those layoffs are soon to come, or they're just not going to come. There's enough demand to support the additional labor. And then Yum Brands, Kroger, and Home Depot, there's no evidence that they overhired. It's just not there, not in the numbers at least. In 2022, their operating margins expanded from pre-pandemic levels. So that doesn't suggest that there's too many people working there.
Brian, let me shift gears on you away from jobs for a second. How about the yield curve? Doesn't an inverted yield curve tell us that a recession is likely?
The inverted yield curves been historically a good predictor that a recession will come at some point.
Mhm.
But it's 6 to 12 to 18 months in the future. That's a fairly long time. And if you normalize that for inflation, it's not as inverted as you might think, right? So we have high inflation now. We got, let's just say the inflation rate today is 6%. Let's say core inflation 5%. And that's where Fed funds is going, right? So real yield is 0. And if you look at the 10-year, the real yield's about 1.5, 1.75, depending on the day. The bond market's so volatile. So we actually have a upward sloping real yield curve. So that would fly in the face of the evidence of the yield curve argument. I think the yield curve being as inverted as it is investors basically saying that it's more likely than not that the Fed's going to have to lower rates over the next 10 years. And they're probably going to lower rates because inflation is going to come down. But just because all that happens does not necessarily mean that we'll have a recession. And I understand that's it seems like we're kind of talking out of two parts of our mouth, right? But when I think of the hard landing, the quote unquote hard landing that people talk about, that's the recession, right? That is when producer prices are so high that companies need to lay people off in order to defend their margins. As people lay people off throughout the economy, the revenues are going to get hit.
Right.
And there's no way to get that economy back going unless the Fed's pretty aggressive about lowering rates, right?
Right.
And as inventories come down. So that's the hard landing. That could certainly happen. And I think there's been that fear more recently of that happening, as we've seen, aggressive jobs being added. We've seen, a less dramatic decrease in inflation over the last month. I almost said the wrong word and said uptick. It certainly wasn't an uptick, but a less dramatic decline. And before that, there was only evidence of either a soft landing or a Goldilocks economy. I mean, we had great job growth. We had falling inflation. It seemed like, all the wages were falling. We went from 6% to about 4%. It looked like we were going to have real wages, falling producer prices, so companies could defend margins, wouldn't have to lay people off, so revenues wouldn't be cut. And it looked like margins could bottom in either a Goldilocks scenario where we continue to have 2 to 3% growth, which seems unrealistic in the long term, or a soft landing. And I think a soft landing is somewhere between 0 and 1% growth. I think that's reasonable, right? We don't have a recession that's painful, or millions of people lose their jobs. But maybe the unemployment rate goes to 4% from the very tight 3.4%. The S&P 500 can continue to grow their margins because producer prices are coming down, but revenues can still grow. And that would be a very nice scenario. Now, what would the stock market do, under all these scenarios, whether it be a Goldilocks scenario, a hard landing, or a soft landing, I think is the real interesting question, right? And there's all sorts of debates about where earnings are going to be for the next 12 months. Is it going to be $230, $240, $200, somewhere in there? And, one of the things that I've been thinking about is, does it really matter? Because if the economy falters and earnings fall to $200 from $220 where they're at now, $225 where they're at now, that likely means that the Fed's going to have to be supportive, and long-term interest rates are going to fall. And if long-term interest rates fall, that's supportive of the stock market. So even if earnings fall, you'd have interest rates fall, and you'd have multiples increase. Now, if earnings are hot and the economy continues to do well, the Fed's going to do the opposite, right? They're going to be able to stay higher for longer, as they've stated, and that aggressive growth in earnings are going to be a little bit offset by interest rates. So I think this is kind of why, since the summer, with the exception of a blip in October, which I think was partially, influenced by what happened in the UK last year, we've been in a kind of a tight trading range, where we've been trading around 4,000 on the S&P 500. If you look at the 50-day moving average, it's, not as volatile as you might imagine, right? It hasn't gone to like 4,400 down to 3,600 on a day-to-day basis. Sure, it hurts, but it's been volatile and it's been hurtful. But if you smooth it out with the 50-day average, you kind of see a line that's around 4,000. And that's around where we are today. So I think that is supportive of this idea that I'm espousing, that whether earnings go down, rates will be supportive, and if earnings do well, rates will dampen the enthusiasm in the stock market. And the only way, we get out of that trading range, and it will happen at some point, is when rates stabilize, inflation normalizes, and earnings continue to start to push the stock market forward. Now, I don't think that necessarily means that we're not going to have any returns. I do think that we'll probably continue to have returns. It just might be more muted. It might be, we've been used to 10, 12% average annual returns. With an earnings yield of 5%, that might be more of the type of return that you might be looking at for the foreseeable future until all this plays out.
So what does that translate to? That people get their returns more in different ways, or less about stock performance, or what are you saying with that?
Well, you can be very tactical, right? I mean, there are stocks that are, not all stocks are the same. First of all, right, and not all sectors are the same. What we've been talking about generally is the S&P 500, which I think is more or less fairly valued most of the time. But as you go lower from the sector level to the industry level to the company level, there's more opportunities where pricing can be more erratic. So that might be a strategy to concentrate if you want to goose some of your equity returns, but that's not going to come without more risk and more volatility, and it's definitely going to require a strong stomach and a lot more research.
Which isn't necessarily everyone's cup of tea.
But
So,
at the same time, this is good for the bond market, right?
yeah, you're getting bigger yields from
you're
your
getting 5+% returns in the front end of the curve now. And if the longer end falls under a hard landing scenario, or just as inflation falls, well, you're going to get a capital gain on that. The worst part scenario for the bond market would be if we're just higher for longer, right? And that has pros and cons too, right? You're not going to get the capital gain, but you will be able to clip that higher coupon for much longer, which could be nice.
Well, it's probably something we can talk about in a future segment, future episode. I mean, I do think this question of, how realistic is it that the Fed's objective to get down to back to a 2% inflation rate, how long is that going to take, and what's the reality behind that? Seems like that's going to be a very challenging thing to accomplish, given, directionally things changing, where we're trying to bring more production to home, to the US and things like that. That's likely to add some longer inflation, I would think. But in any case, I can see you're ready to jump in, but we got to take a break for the news. And I want to just mention to everybody, if you have an interest in talking with our team here at Asset Management Resources, if you have questions about your portfolio, is it properly constructed to meet your needs, tailored to your situation, it'd be a good time to come on in. We offer a complimentary consultation. Happy to see if we can be of help to you in the process. 508-771-8900 is our local number. Toll free, 866-771-8901. Or you can connect with us through our website, amrfinancial.com. We'll be back after the news for another hour of Something More with Chris Boyd. Stay with us. So I could see you were ready to jump in on that, but I didn't have time. I don't know. What do you think?
About what? About what's the topic?
Whether inflation's going to stay higher longer. I mean, the idea of 2% inflation seems improbable to get to, particularly if we're talking about trying to bring some industries back to the United States, where labor costs are going to be higher, and it doesn't seem like you're going to have the benefit of what we've had, this free trade benefit over the last 30 years, where we've been kind of pushing production and costs down by going overseas. We're going to kind of have the inverse of that. Seems likely that's going to have some inflation impact.
Yeah, it could. I mean, it's not priced into the market. If you look at the 5-year forward, which is the expectation of inflation 5 years from now, or the 10-year tips break evens, we're looking at like 2.25. So the market thinks in time we're going to get down to a reasonable inflation. I think it's almost an inevitability that this year inflation is going to fall a lot, for a few reasons. The big one is the base effects are going to roll off in the next 3 months. So
yeah, I'm not really
I'm
just questioning, is 2% the target? Is that achievable?
I think we're going to be a 3 handle in 2023. So I think it's yes. I mean, a
3 handle seems like, to me, historically, that's what we used to talk about, is the inflation rate.
3 is not bad.
I don't think that anybody will have too many complaints about 3. And I think that's almost an inevitability. I mean, obviously we could have another war, or an escalation in the current war, or something like that. But just with the base effects rolling off, it's going to fall a lot over the next 3 months. And then in the second half of the year, the housing numbers, which are driving up inflation now, that's the biggest thing, are going to start to fall.
Yeah.
And they could actually be negative. So they're adding 0.7, 0.8, 0.9% per month to the inflation rate. So that, call that like 1.5% just from housing. If that goes negative in the second half of the year, you could be looking below 3 just there. And we saw this during the pandemic, we saw a big shift to goods. And then we saw everything switch back to services, and services are still hot, but it's not going to be hot forever. And if that starts to be less hot in the second half of the year too, that's when the Fed might get their layoffs that they're looking for. And I also think, that could bring inflation down, even further. So, I think what the items that you're talking about, Chris, are, real, like basically the reversing of all the globalization that's essentially what you're talking about, right?
Yeah.
I think that's real. I think it's a beyond 2023 thing.
Yeah, I agree. I don't mean it as an immediate thing, but long term.
Also puts more pressure on our labor market, though.
So if you think
creating
about
more jobs here.
Yeah, true.
If you think about, in the 2010s, we had inflation around 1.7, 1.8, and now the market's expecting 2.25. That's not an insignificant change. That's a, call it 25, 30% change in the expected inflation rate.
Yeah, that's a good point.
So, that I'm not going to lose sleep over 2.25. I don't think any of us would, right? But it is an expected, a pretty big expected increase over the next 10 years.
It's a good point. Doesn't have to go as high. I just got a notification that we've got our next guest in just a minute. So a couple minutes. Brian, thanks so much.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.